Ladies and gentlemen, Asian guy here. The $75 silver floor just defended after a market-wide bloodbath, while China's 91 trap exploded. The battle for physical control has begun. Silver held $75 on COMEX, while Shanghai physical metal is trading at $91. That's a $16 premium, the widest sustained spread in modern silver history. This isn't a pricing error, it's a confession. The Western paper market is bleeding and the physical market is ripping it apart. I need you to stop watching the price and start watching the data, because what's happening right now will determine if $75 is a floor or a trapdoor, and whether the paper shorts survive or collapse. Let me show you the numbers that tell the real story. Silver trades at $75 on COMEX futures, but physical delivery in Shanghai is $91. That's a $16 spread, the widest sustained premium in modern silver history. Do the math with me. If you could buy COMEX and deliver to Shanghai, you'd make $16 per ounce profit. But here's the problem. Nobody can close that arbitrage. The spread exists because there is no physical silver available to move from west to east. Western vaults are being drained, and refiners are prioritizing Asian buyers who pay cash premiums. Connect the dots. When arbitrage breaks, it means the paper price is a lie. The Shanghai premium is the physical market screaming, "I want the metal now." Banks that are short paper silver cannot deliver into Shanghai at any price. They are trapped between a $75 paper obligation and a $91 physical reality. This is not speculation. This is live pricing data from the Shanghai Futures Exchange. Every day the spread widens, the paper short position becomes more impossible to cover. The arbitrage mechanism that's supposed to keep these markets aligned has snapped. Under normal conditions, traders would buy COMEX, take delivery, ship to Shanghai, and pocket the difference. That's how markets stay connected. But we are not in normal conditions. The physical metal isn't available to ship. The refiners who could produce deliverable bars are already backlogged with orders from Asian industrial buyers. And the banks holding short positions on COMEX cannot source enough metal to satisfy even a fraction of the contracts they've sold. This spread is not a temporary dislocation. It's a structural break. It's the market telling you that the paper price has lost its authority over physical supply. The COMEX price is what banks are willing to settle contracts at. The Shanghai price is what buyers are willing to pay for actual metal, and the gap between them is widening. Now, you need to understand what this means for the $75 floor. The floor is holding because physical buyers are stepping in at that level. Industrial users, solar manufacturers, electronics producers, EV battery makers, they need the metal. They are not trading, they are buying. And they don't care about COMEX price discovery, they care about securing supply. So when the price dips toward $75, they absorb the selling pressure. But the Shanghai premium tells you something critical. Those same buyers are willing to pay $91 if they have to source from China. That means the $75 COMEX price is artificially low. It's being held down by paper selling that cannot be backed by physical delivery. The banks shorting silver on COMEX are creating synthetic supply through futures contracts. But the physical market is rejecting that synthetic supply. And the proof is the $16 premium in Shanghai. This brings us to the smoking gun. The arbitrage is broken because the paper shorts cannot deliver. The Shanghai-COMEX spread is not a pricing inefficiency. It is a confession that the Western paper market has lost control of physical supply. The floor at $75 is holding, but it's fragile. It's being defended by physical buyers who are willing to step in at that level. But if those buyers decide they'd rather pay the Shanghai premium and secure guaranteed delivery, the floor collapses. Because the paper shorts have no metal to deliver. And when the market realizes that, the price doesn't just break the floor, it gaps. Now let me show you what's happening inside the COMEX vaults. COMEX registered silver, the metal available for delivery, has been falling for months. We are now at multi-year lows in deliverable inventory. Registered silver is the only metal that can be used to settle futures contracts. When registered inventory falls while open interest stays high, it's a mathematical trap. The ratio of paper claims to physical ounces is now extreme. Banks are not delivering metal. They are rolling contracts forward and paying cash premiums to avoid delivery. This is called EFP, exchange for physical, and it's spiking. EFP volume is a measure of how many traders are saying, "I don't want your paper, give me the metal." When EFP spikes, it means the futures market is failing its core function, price discovery through delivery. The COMEX is becoming a cash settlement market, not a physical delivery market. And when that happens, the paper price loses its authority. The Shanghai premium is proof the physical market no longer respects COMEX pricing. Let me break down what registered inventory actually means. COMEX vaults hold two categories of silver, eligible and registered. Eligible silver is stored in the vault, but not available for delivery against futures contracts. Registered silver is what can actually be delivered. And registered inventory has been bleeding out. We're talking about a sustained drawdown over multiple quarters. This is not a temporary fluctuation. This is a structural drain. The metal is leaving the vaults because industrial buyers are taking delivery. They are not rolling their contracts. They are standing for delivery and pulling the metal out. And the banks that sold those contracts are scrambling to source physical silver to meet those delivery obligations. But here's the problem. They can't source enough. The refiners are backlogged. The miners are selling directly to Asian buyers at premiums. And the secondary market, scrap silver, recycled metal, is not producing enough volume to fill the gap. So what are the banks doing? They are paying EFP premiums to convince contract holders to settle in cash instead of taking delivery. They are offering a cash bonus to make the problem go away. But EFP volume is spiking because more and more traders are refusing the cash settlement. They want the metal, and the banks are running out of options. This is why the registered inventory drawdown matters. It's not just a number on a chart. It's a measure of how much physical silver the COMEX system has left to defend the paper price. And that number is shrinking. Every ounce that leaves the vault is one less ounce available to settle future contracts. And the open interest, the number of outstanding futures contracts, is not falling. It's staying elevated. That means the leverage in the system is increasing. The ratio of paper claims to physical ounces is getting worse. And at some point, the system breaks. When registered inventory falls below a critical threshold, the market loses confidence in the COMEX's ability to deliver. And when that confidence breaks, the paper price becomes irrelevant. Because the physical market will set its own price. And that price will not be $75. It will be whatever buyers are willing to pay to secure guaranteed delivery, which, as Shanghai is showing us, is $91. But it's not just the vaults that are bleeding. The short sellers are in crisis. The Commitment of Traders report shows commercial short interest at extreme levels. These are the banks and market makers who sold silver they don't have. They sold it expecting to cover at lower prices or roll the contracts indefinitely. But the $75 floor is holding, and they cannot shake it. Every week, they hold these shorts, they bleed funding costs and margin pressure. The bloodbath you saw in the broader market was an attempt to break $75 and trigger stop losses. It failed. The floor held because physical buyers stepped in. Industrial users who need the metal. Solar manufacturers, EV battery producers, electronics companies. They are not trading, they are buying. And they don't care about COMEX price discovery. They care about securing supply. The commercial shorts are now trapped between rising physical demand and falling vault inventory. They cannot deliver into Shanghai, they cannot source enough metal to cover, and they cannot break the $75 floor. This is the endgame of a fractional reserve metal market. The paper shorts are being forced to choose deliver metal they don't have or default. Now let me explain what the COT data is actually telling us. The Commitment of Traders report breaks down futures positions by category. Commercials, large speculators and small speculators. Commercials are supposed to be hedgers, miners, refiners, industrial users. But in the silver market, the commercial category is dominated by banks acting as market makers. And these banks are net short, heavily net short. The current positioning shows commercial shorts at levels we haven't seen since the last major silver squeeze. These are not hedges. These are speculative bets that the price will fall. Or, more accurately, these are positions designed to suppress the price. The banks sell futures contracts to create synthetic supply and cap upward price momentum. Under normal conditions, they can manage this by rolling contracts forward or settling in cash. But we are not in normal conditions. Physical demand is overwhelming the system. Industrial buyers are standing for delivery. Registered inventories are falling. And the Shanghai premium is exposing the fraud. The banks cannot deliver at $75 because there is no metal available at that price. The physical market is pricing silver at $91 in Shanghai. So the banks are trapped. They are short at $75, but they cannot source metal below $91. That's a $16 per ounce loss on every contract they have to physically settle. And they have millions of ounces in open short positions. Do the math. If they are forced to cover even a fraction of those shorts by sourcing physical metal, the losses are catastrophic. So what are they doing? They are praying the $75 floor breaks. They are selling more paper to try to trigger a cascade. They are paying EFP premiums to avoid delivery. And they are hoping physical demand eases before the vaults run dry. But none of that is working. The floor is holding. The vaults are bleeding. And the Shanghai premium is widening. The commercial shorts are not in control. They are in survival mode. And the longer this standoff continues, the more unstable the system becomes. Because at some point, one of these banks will blink. One will decide the risk of holding the short position is greater than the cost of covering. And when that happens, the scramble for physical metal will be unlike anything we've seen in modern markets. So what does this mean for you right now? The $75 floor is holding, but it's not guaranteed. Here's how to track whether it strengthens or breaks. First, watch COMEX, registered inventories. If they stabilize or rise, the floor is reinforcing. If they continue falling while open interest stays elevated, the floor is fragile. Second, watch the Shanghai-COMEX spread. If it narrows back under $10, the arbitrage is healing. If it widens past $20, the paper market is losing control entirely. Third, watch EFP volume. Sustained high volume means physical demand is overwhelming paper supply. If EFP drops back to normal levels, it means the delivery crisis is easing. Fourth, watch commercial short positioning in the KOT report. If shorts start covering aggressively, it signals capitulation. If they hold or add to shorts, they are betting they can outlast physical buyers. Fifth, watch industrial demand data, solar panel production, EV sales, electronics manufacturing. If these sectors slow, physical demand eases and the floor weakens. If they accelerate, the floor becomes a launch pad. Here's the scenario where the floor breaks. Inventories fall below critical levels, a major industrial buyer fails to secure supply, and the COMEX is forced to cash settle contracts. That would destroy confidence in paper pricing and send physical premiums to extremes. Here's the scenario where the floor defends and launches. Shanghai spreads compress as Western refiners redirect supply, inventories stabilize, and shorts capitulate. That would validate $75 as the new structural floor and set up a move toward $100. You need to track these data points weekly. This is not a set and forget market. The battle between paper and physical is happening in real time. Now let me give you the practical framework for monitoring this. Check registered inventories every Friday when COMEX releases vault data. Look for the trend, not the daily noise. A single week of inventory decline means nothing. But 3 consecutive months of drawdowns? That's a pattern. Track the Shanghai-COMEX spread daily using live futures pricing and Shanghai Futures Exchange data. The spread will fluctuate intraday, but the weekly average tells the real story. If the average weekly spread is widening, the physical market is pulling away from paper pricing. Monitor EFP volume through CME Group's published data. High EFP volume means traders are rejecting paper settlement and demanding physical delivery. If EFP volume stays elevated for multiple weeks, the delivery pressure is not easing. Watch the COT report every Friday after market close. Focus on the commercial net short position. If it starts declining sharply, the shorts are covering. That's the signal that the paper market is capitulating to physical reality. Track industrial demand through sector-specific data. Solar installations, EV production numbers, semiconductor output. These are the end users driving structural silver demand. If these sectors remain strong, the physical buying pressure continues. Do not let anyone gaslight you into thinking this is normal. A $16 sustained premium between Shanghai and COMEX is not normal. Multi-year lows in registered inventory while open interest stays high is not normal. Spiking EFP volume is not normal. These are symptoms of a fractured market where paper pricing has lost its grip on physical supply. The $75 floor is being defended by real buyers with real demand. But the Shanghai premium is exposing how fragile the paper pricing mechanism has become. Track the checklist, watch the data, and understand that what happens next will be determined by whether the physical market forces the paper market to capitulate or whether the shorts can engineer one final flush to shake out the buyers defending $75. The $75 floor survived the bloodbath, but the Shanghai trap is tightening. Track the checklist, inventories, spreads, EFP, shorts, demand. If you want to see the next phase of this crisis, watch the follow-up video. Subscribe. This story is not over.